Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at Beyond Meat.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comment section below.
So let's get into the analysis. And, we really aren't looking at a high-growth startup anymore.
No, not at all. We are looking at a distressed turnaround play.
A very distressed one. Beyond Meat is, it feels like they're facing an existential crisis. They're trying to hit these incredibly ambitious targets while their core market is, well, it's shrinking.
It really is a binary investment case, isn't it? Either they pull off this flawless operational reset and become a lean, profitable niche player.
Or they just continue that slide toward, irrelevance.
Exactly. So let's unpack that core challenge. I think we have to start with the cold, hard reality from their Q3 2025 results.
Absolutely. The headline numbers just poured cold water on any recovery hopes. Overall revenue was down 13.3%.
Which is tough.
It's tough. But the real pain is domestic. U.S. revenue dropped a staggering 21% year over year.
21%. That's not just a cyclical slowdown.
No. That reflects a fundamental pressure on demand in the whole plant-based category. It's driven by a bit of consumer taste fatigue and, of course, inflation pushing people back to cheaper traditional meat options.
Right. When you see a contraction that big in your home market, it just tells you that the momentum that built the entire company has, for now, completely evaporated.
Is it gone?
So for any turnaround to work, you almost have to ignore the sales line for a minute and look at the cost side. Which brings us to the margin story.
The very volatile margin story, which is the key to any bull case here. Profitability is everything right now.
They just have to prove they can run a financially viable business.
Something they have yet to do consistently. Their gross margins have been a wild roller coaster. It just indicates massive instability in their whole production process.
You look back to 2023 and the gross margin was negative 24.1%.
Just think about that. They were losing a quarter on every single dollar of product they sold.
Insane. Then 2024 showed this huge surge to a positive 12.8%. That felt like a sign they were making headway.
It was a glimmer of hope. But that progress just didn't stick. The first 9 months of 2025, margins slipped right back down to 6.9%.
Q3 was a little better at 10.3%, but the volatility, it just shows they haven't fixed the core supply chain issues.
And that volatility translates directly into massive cash burn. We need to remember the scale of those operational losses. It was, $112.3 million in Q3 alone?
Yeah, that kind of cash destruction is completely unsustainable, which is why management has been forced to set these incredibly aggressive targets for 2026.
And those 2026 targets, that's what the entire investment thesis hinges on now.
2 huge milestones, 20% gross margins, and crucially, positive EBITDA by the end of 2026.
Right. And for you, the listener, understanding these terms is really essential to grasp the risk here. Let's break that down.
Okay, so positive EBITDA.
Yes, EBITDA. That's earnings before interest, taxes, depreciation, and amortization. It's the metric that matters most. It means they expect to finally stop losing money just from running the core business.
So just producing and selling their products.
Exactly. Before you even account for financing costs or big non-cash charges, going from a $112 million loss to positive EBITDA in that time frame is a massive leap.
And aiming for a 20% gross margin, considering they've been bouncing between 6 and 12% recently, that just seems mathematically impossible without some kind of drastic action.
It would be. So how do they plan on executing that kind of operational magic trick?
That's the question.
It's a three-pronged strategy, and it's focused entirely on efficiency and scale. First, cost resizing.
Layoffs and plant consolidation.
You got it. Shrink the fixed expense base. Second, a massive portfolio simplification. They're cutting all those low-margin, complex products.
To focus resources on things like the Beyond Steak and the core burger.
The high-margin items, yes. And third, just squeezing greater efficiencies out of production and logistics. Better contracts, better supply chain integration.
So the narrative has completely shifted. It's gone from growth at any cost to survival through efficiency.
That's a perfect way to put it.
But what's fascinating is how Wall Street is reacting to this plan.
They seem to be betting on the execution. Consensus estimates are projecting truly substantial EPS growth. That's earnings per share.
Okay.
We're talking 51.5% for the current fiscal year.
Okay.
And then looking forward, nearly 70%, 69.6% for the next year.
Wait a second. That's where I have to push back a bit. How can analysts project nearly 70% EPS growth when we just established that U.S. revenue is forecast to decline another 15% in 2026?
And that is the absolute key question here.
I mean, doesn't that projection depend entirely on a level of operational efficiency they've never, ever demonstrated before?
You've hit the nail right on the head. The market is absolutely not betting on sales growth.
Okay, so it's a cost story.
It's purely a cost story. The consensus projections are based entirely on the belief that management will succeed in ruthlessly slashing costs, hitting those 20% margin targets, and radically shrinking the net loss per share, even if the top line keeps falling.
It's a pure execution bet, not a market demand bet.
Exactly. Which brings us back to their financial foundation. If they're betting it all on efficiency, they need to make sure the house isn't crumbling.
Right. They've taken actions to improve liquidity, but the sheer weight of their debt is the anchor here, isn't it?
It is the single biggest fundamental risk. Yes, they improved their cash position through some balance sheet maneuvers, but that's offset by a heavy debt load and these persistent losses.
Yeah.
Net losses are actually projected to hit $232 million in 2026.
And that's even with the expected cost savings factored in.
Correct. This constant cash burn means the focus is 100% on operational survival and debt reduction.
So for anyone considering this investment, you have to understand the rules of the game here.
You do.
They're just reinvesting any operational gains back into R&D and shoring up the balance sheet. This means zero focus on shareholder returns. No buybacks, no dividends.
Nothing. You are purely betting on the turnaround story, hoping for capital appreciation way down the road.
And the only way that story works is if they have something proprietary that justifies all this risk.
Right. In a market this crowded, with rivals like Impossible Foods and even huge commodity players like Tyson getting in the game, whereas Beyond Meat's competitive moat.
Their edge seems to be rooted in proprietary tech, and they're doubling down on it. It's their unique plant-based protein formulations and the IP they hold in cleaner ingredient innovations.
And the key differentiator they're pushing right now is the Beyond Burger 3.
Let's talk about that, because this is where the story gets interesting, where the tech meets the marketing.
It is. The Burger Third isn't just a slightly tweaked recipe. It's a fundamental structural change. They've improved the protein matrix. They've focused on removing some of those controversial processing aids.
Like methylcellulose.
Exactly. And they've tried to fundamentally address the off-flavor and textural issues that critics always pointed out in the earlier versions.
And that innovation ties directly into the ESG narrative, the environmental, social, and governance story.
Which, while it's easy to overlook in all the day-to-day volatility, is crucial for institutional investors.
Absolutely. The Burger Serve isn't just about taste, it's about their environmental footprint.
They can demonstrate measurable, quantifiable environmental benefits versus traditional beef. We're talking significantly lower land use, water consumption, energy, and critically lower greenhouse gas emissions.
They highlighted this in their recent corporate responsibility report, right? Including their submission to the CDP.
Yes. And the CDP, that's the Carbon Disclosure Project, it's a global nonprofit that runs the world's leading environmental disclosure system.
So submitting and scoring well there, that's a signal.
It's a huge signal to major institutional funds that Beyond Meat is serious about sustainability. When demand eventually stabilizes, their demonstrable ESG advantage positions them perfectly to capture the attention of funds that have a strict mandate to invest based on these criteria.
So you have an IP edge and a clean environmental narrative, but financially, it's a mess. Let's pivot to the market reality, because this stock does not trade on fundamentals alone.
Not even close. It has serious meme stock characteristics.
It's defined by volatility. This is where high-risk traders thrive, and long-term investors get very, very nervous.
You just have to look at the trading action from mid-October 2025. The price absolutely rocketed from 50 cents all the way up to $7.69 in just a matter of weeks.
That is just insane volatility. That's the kind of short squeeze potential that creates instant and often temporary millionaires. It captures that wild speculative side of the market,
where fundamentals are secondary to technical triggers. And that's why technical traders watch those floor levels so closely.
They're looking at those support levels near 80 cents to $1.
As potentially attractive entry points, yes. They're betting that if the next earnings report brings any whiff of good news, the short interest is high enough to trigger another massive squeeze.
It really is a high-stakes technical play layered directly over a fundamental Hail Mary turnaround. But let's not ignore the shadow hanging over the stock. We need to talk about the bear case and the negative sentiment.
Okay, so the momentum from the positive earnings estimate revisions and their strong ESG report is real. But the critical counterargument is the legal and financial uncertainty.
Right, the ongoing securities fraud investigations.
We have to address those. Firms like Pomerantz Law have issued alerts about probes tied to late 2025 impairments and losses.
And what are they actually looking into?
Essentially, they're investigating whether the company misled investors or misrepresented its financial health regarding certain losses. That kind of legal scrutiny creates heavy negative sentiment.
And it clouds the entire recovery story. It suggests the financial problems were even worse than what was initially disclosed.
And that risk, combined with the forecasted 15% revenue decline in the U.S. for 2026, it seems to be fully priced in, judging by the valuation.
Oh, absolutely. The market has completely discounted this equity. The enterprise value is sitting at, what, around $1.7 billion?
To put that in context for you listening, that valuation is roughly 99% off the stock's all-time high from its IPO days. The market has been absolutely ruthless.
Okay, before we get to catalysts, let's quickly check institutional and insider flow. Are the people running the company or the big funds showing any confidence?
The flow leans cautious. We saw some routine insider activity, which is worth explaining. Director Chelsea Grayson sold 492 shares, but it was done under Rule 10b-5-1.
And for those unfamiliar, what does that signal?
It's a key detail. Rule 10b-5-1 allows insiders to set up a pre-scheduled automated trading plan in advance.
So it's not a panic sale.
Not at all. It shows the sale was planned well before any recent news cycle. It's automatic. She still holds over 40,000 shares, so it wasn't a fire sale.
And what about the big money?
That's more important. We haven't seen any major institutional accumulation in recent filings. They're all sitting on the sidelines waiting for proof.
Which makes perfect sense. So given this extreme volatility and the need for proof, what are the near-term catalysts we need to be watching?
The primary catalyst is the Q4 2025 earnings release. We expect that in early February 2026.
Okay. Consensus is eyeing an EPS of $1.12 for the full fiscal year.
Yeah, but honestly, the actual loss number is almost secondary to the market's real focus.
Which is going to be that demonstrated progress toward the 20% gross margin target.
That's it. Management needs to show they are successfully executing on those cost controls right now. They have to prove the operational reset isn't just rhetoric.
They need tangible margin improvement in Q4.
Yes, they have to show they're on track to hit those 2026 goals. A miss on margin progress or any sign the efficiencies are failing would be extremely painful for the stock.
And then there's always the macro environment, that sort of low probability, high impact tailwind.
That's the speculative hope. That sector rotation will benefit them. If the Fed starts cutting rates, maybe some of that capital flows into undervalued food stocks.
And Beyond Meat's strong ESG narrative could benefit disproportionately.
It could. It's a nice potential bonus, but it's not the primary reason to invest here.
Okay, let's wrap this up with the final contrarian thesis. Looking at all the risks, declining demand, massive debt, legal probes, how should an investor approach this?
The current extreme valuation is exactly what provides that contrarian upside. The entire investment thesis is built on a massive if.
A huge if.
If the cost controls successfully deliver that ambitious 20% gross margin and positive EBITDA by the end of 2026, the stock will instantly re-rate and leverage its strong ESG-led product innovation.
It's a classic high-risk, high-reward binary outcome. There's really no middle ground.
None at all. So your time horizon should dictate your strategy. If you're looking for that quick, massive speculative pop, you might swing trade into the Q4 earnings.
Betting on a short squeeze?
It's exactly. Or an overreaction to good margin news. But if you're truly buying into the fundamental turnaround, you need a 6 to 12-month hold. It's a monitoring mission. You track the quarterly achievement of those very specific turnaround milestones.
Especially margin progression.
Ultimately, the story of Beyond Meat right now is a fascinating race between aggressive, deep cost management and whether the underlying plant-based demand in the U.S. can stabilize enough for their ESG advantages and IP moat to truly shine. For more quick evidence-based analysis like this every day, be sure to subscribe to Smart Wealth with Joshua.